welcome again to our fantastic guests joining us today. And joining me on the stage are my dear colleagues, Alena Schollmayer and Ameer. Welcome again. And we are back with a fantastic market update for, actually, it's H1 of 2023, so Q1 and Q2. And we'll dive into that in a bit. Maybe, Alena, you can go on to the next slide. Maybe before we get started, just a little bit of context for everybody who doesn't know as much about us. So I'm Stephan Heller. I'm one of the founding partners of AQVC. AQVC stands for Alpha Q Venture Capital, and Alpha Q stands for Alpha Quartile. So we try to be very smart about this name, but at the end of the day, we are mostly driven by the democratization of venture capital. I'm a serial entrepreneur, so are my partners, and investing in venture capital is obviously super exciting, but it's also sometimes very risky. So if you invest directly into startups, this can be very risky. And if you want to invest into funds, this is sometimes also very difficult because some of the funds are very access constrained, so they're difficult to get into. And a lot of the emerging managers, they're very hard to select because you have hundreds of emerging managers. And unfortunately, not all of them will make it. And so it's very important to have a balanced strategy. That's what we are focused on. So we invest into established and emerging managers. We are structured as an evergreen, so we have rolling quarterly closes. Investors are coming in with a minimum ticket of 200K every quarter. And we are investing into fantastic venture capital funds, mostly in Europe, the US, and Israel. With me today, and this is far more exciting, are my fantastic colleagues. Maybe, Alena, we start with you. Do you want to quickly introduce yourself?
Yes, very happy to. Thanks, Stephan, for setting the scene. Hi, everyone. I'm Alena. I joined AQVC last year in the investment team together with Ameer, actually from the direct investing side, having learned a bit about early stage investments in Europe, working for a Japanese company, and now also getting to know the venture capital ecosystem better as an LP. Very excited to be here today and share our view on the market of this very exciting first quarter and year. Over to you,
Maybe before
Ameer.
we jump to Ameer, Alena, what was the last deal you led and announced?
Stephan is pushing, but that's good. So very proud deal owner of our last investment into a climate tech fund, being Pale Blue Dot, and their second fund generation. We've been speaking to them for quite some time. So this was a very well built up relationship, and we're super happy to work with them, and also with that increase our exposure to climate tech funds and in general funds that are SFDR 8 and 9 compliant, because also our LPs are really looking into getting not only financial returns but also impact back.
Great, yeah, absolutely. And this was our 9th investment. So there are many more we can talk about, but before we do that, maybe quickly, Ameer, over to you.
Thank you, Stephan. Hello, everyone. So Ameer Awadiyeh, VP of Investments at Alpha Q, joined last year as well to lead the investment efforts together with Alena. Before joining AQVC, I spent over 6 years at Vintage Investment Partners doing fund of funds, secondaries, and late-stage investments across North America, Europe, and Israel. And before that, spent some time doing consulting with EY and BDO. Super excited to share with you our findings today, and yeah, let's together with my colleague Alena, we will try to walk you through some of the updates and observations that we've seen during Q1 and some year-to-date information as well into 2023. So I will start with some high-level observations into what we've seen across the different aspects of the tech ecosystem, and then dive a little bit deeper into some of them, starting with global investment activity, where we saw a 13% quarter-over-quarter decline, a continued downward trajectory with initial signs of stabilization coming from the US, and with France showing signs of resilience in the European ecosystem. Then going on to discuss valuations, where we previously expected to see that the decrease in late-stage valuations trickle down to seed stage. The data actually shows a remarkably different picture, which we will touch on in a couple of slides. After that, we will go on to discuss VC fundraising, where we saw 99 funds raise a total of $12 billion in the US, which is more or less matching the amount that was raised in the previous quarter. And for the full year, we estimate only a third of what has been raised in 2022 to be raised in 2023. What we also continue to see on the VC fundraising front is the noticeable shift among limited partners towards more established versus emerging fund managers. And then finally, we will touch on the exit markets a little bit, some of the M&A activity that many of you have been following, of course, starting to rebound in the last few months, especially when it comes to companies building in the AI and ML space, and we will discuss that a little bit as well. So starting with the funding activity, as expected, no surprises here, with VCs continuing to cautiously slow down their deployment pace, and with startups cutting costs and increasing time between funding rounds and extending their runways, Q1 2023 funding dropped a further 13% quarter over quarter, which hit a 3-year low and closed at roughly $59 billion being raised by startups in the first quarter of the year. As you can see, we are now starting to get to early 2020 numbers when it comes to deal count and deal volume. And as I had mentioned earlier, given that the LP appetite for VC is still somewhat sluggish, we expect to see managers continuing to be careful with their capital deployment as they assess demand from their LPs for future fund generations. Looking at the geographic breakdown of the decline in VC activity, you can see that the major contributors to the decrease are Latin America and Asia, dropping 54% and 27% quarter over quarter respectively, with Europe being in line with the global trend. However, when you look at the US remains stable, with US-based companies raising a total of $33 billion in Q1 of 23, and that accounts to a total of 55% of the global funding, and it showed a more moderate 1% only decrease quarter over quarter. However, need to keep in mind, Stephan, that this number climbs to a 20% decrease in total when excluding Stripe's enormous $6.5 billion round during the quarter. Now, zooming in on Europe a little bit, as you can see in the chart on the left-hand side, the main changes in 2023 year-to-date numbers versus the last year in terms of share in VC deal value are: one, there was a decrease of approximately 250 basis points in each of Israel and the Nordics. And two, another noticeable change was an increase of over 650 basis points in France and Benelux, which can be mainly attributed to the vibrant ecosystem in Paris. Now, taking a closer look at France, if you look at the graph on the right-hand side, you can see that despite the broader macroeconomic challenges, the VC deal value and count increased in Q1 2023 versus Q1 2022, reflecting, as mentioned earlier, the resilience of France's underlying economy, with Paris maintaining the position that it claimed from Berlin last year as the second top VC hub in terms of deal value in Europe. What we also noticed, which was new, was that other regions in France started appearing in the top 15 European hubs for the first time ever. And that signals that there might be some other smaller hubs emerging in France outside of Paris. Now, we think, or we know, I think by now, that this is mainly attributed to a strong push from the French government over the last decade and even more, promoting various labor and tax reforms, as well as much simpler visa processes, especially for Czech entrepreneurs, which boosted the entrepreneurship and investments in the region. I think with the final goal of establishing a leadership position for France in the European tech ecosystem. And we believe that all of that, in addition to the recent emergence of large tech unicorns coming out of France, will result in basically the emergence of new wave of high quality entrepreneurs building amazing companies coming out of the region.
Maybe very quickly, Ameer, before we continue. I mean, it's super interesting that France is now becoming this VC and startup like superpower, really, right? I mean, 10 years ago, it was mostly the UK and Germany. And as you mentioned, the investment the French government and firms have made into venture capital as an asset class has created a significant growth of the ecosystem. What are the funds, or what fund behavior do you see that you are also excited about? I know that we, from an investment team standpoint, we've looked in, or we are looking into France, but what's exciting you about the sort of fund landscape in the ecosystem?
Yeah, that's a super interesting question, Stephan. So basically our view was we wanted to kind of like, okay, take a step back, take a look at Europe, what has happened during the last 10 years, what worked in the last 10 years, and what will work 10 years from now, and maybe even more. And what we realized was that, as you mentioned, 10 years ago, you could have covered Europe as a VC, either from London and Germany, right, without the really need of having boots on the ground and different smaller tech ecosystems around Europe. And many funds actually did very well and got good coverage of some of the kind of like more remote, smaller ecosystems. But as the ecosystem matured, you are basically seeing the emergence of these tech hubs, evidently with Paris. And what we realized is that, especially to capture the opportunity on the seed stage side, right? Like very early on, tech founders, high quality building in a super interesting space, a mixture of both experienced founders, but also first-time founders. They will want somebody close to them, somebody with boots on the ground. So we figured that, especially in France, maybe we need to have, from a fund manager perspective or from a fund-of-fund portfolio perspective, we need to have a couple of funds with boots on the ground in France covering the seed and pre-seed stage ecosystem, because we're probably not going to get that from the more established fund managers. So that's kind of like the idea that we came about when we were discussing and looking closer at the French ecosystem. And we have discovered 5 or 6 purely focused pre-seed and seed stage funds leading rounds in France, and are currently in different evaluation phases, hopefully to kind of like choose 1 or 2 to back that will hopefully give us, enable us to enjoy some of the value creation that I'm sure will happen and come out of the region in the next few years.
Nice, thank you. Over to you, Alena, I think.
Yes, I'm now handing it over to my great colleague, Alena, that will discuss with you valuation trends and some fundraising activity. Thank you.
Thank you so much, Ameer, for the great introduction and the overview. As Ameer has already previously mentioned, I want to touch upon the valuations and what we've seen in the market in Q1. And as again already mentioned, we were expecting to see the trend of a decrease in late stage valuations really trickle down to the seed stages in this very first quarter of 2023. However, the data is showing a slightly to a very different picture. Let's start with looking at the later stages. We can see a slight decrease in the median pre-money valuation, going down another 10% versus the last quarter to 55 million, after having increased by 10% in Q4 over Q3 2021. So overall, the stage is following the downward trend from late 2021, which we also expect to continue at least until the end of 2023, as public and private market pricing still converges. And as you know, further down rounds will probably happen not only in the European, but in the global VC ecosystem. When looking at the early stage valuations, we can see that median pre-money valuations also continued decreasing, however, coming in at only 6% of a decrease from 41 million to 38 million US dollars, after having decreased slightly more over 10% last quarter. We believe that there will be a further decrease in 2023 until valuation get approximately to historic levels of 2020. Looking at the seed stages, that's where it gets really interesting. And we can actually see an upwards trend in the median pre-money valuation that started since Q1 2020. You can see that on the left-hand part of the slide here. This kind of upwards trend continued into Q1 2023, registering a 17% increase and nearing $13 million of median pre-money valuation in this quarter. Therefore, we think that what we mentioned during our last webinar can now definitely be attributed to what we're seeing in the field. So first, many established funds are now focusing on seed stage investments because they are the furthest away from exit events, and this optionally gives them more time until the exit windows reopen. Ameer will talk about that a bit more later. And since established VCs usually have bigger fund sizes, they also need to invest larger amounts, which again usually pushes the valuations, especially at these very early stages. Secondly, VCs are deploying more carefully in the current market environment, leading to most of the deals that are being done at the higher quality ones. We call them rush to quality deals, are the ones with more traction, justifying higher valuations again. All in all of the above factors, and also keeping in mind that all of the analyzed data only accounts closed deals, which have decreased in count significantly, are leading to the slight increase we're seeing in median stage valuations, especially in the seed stages. But we as AQVC think that the seed upwards trajectory should stabilize at some point during 2023.
I mean, very quickly, Alena, because we see, obviously these are US numbers, right? I think they're always a good proxy also for what is happening in the other more established ecosystems around the world. But what's your point of view on that? What do you see in at least our investment areas, which are mostly all over Europe, including the UK as well as Israel? Where do you see seed valuations move? And also, I mean, what is interesting here is that the deal count obviously has decreased significantly. So the money is concentrating around certain companies. Yeah, this would be sort of the second question. Do you see certain sectors or patterns that in these companies that still receive funding at seed stage where the valuations are continuously going up?
Yeah, thanks for the great question, Stephan. So I think both questions are very much intertwined because there are definitely sectors, like you name it, climate tech, AI, ML, but still kind of, at least partly Web3, are still very much hyped, and not only in a hype cycle, but like also very successfully hyped, and hopefully also in the long term, that these valuations are like super reasonable and make a lot of sense. However, what we also see is that especially emerging managers are having a really hard time focusing on pre-seed and seed deals, because sometimes they just get pushed out of the more established funds that with the current market environment are increasingly starting to focus onto the earlier stages as well, which gives them a very hard time in getting into the deals that they claim to be their sweet spot. So the next time, or like the next quarters, will definitely show what emerging managers will do with that. I already talked to one or two that said that they consider also focusing a bit more towards kind of cheaper Series A rounds, because they are still, especially in the European environment at the moment, very close to the valuations that are happening in the seed stages.
So this is quite interesting, because I mean, in being now in VC and startup, the ecosystem for almost, you know, over a decade, well over a decade. The funds that you mentioned, without naming any names, I mean, these early stage European generalist funds, that all of them used to do seed, right? They all moved up the value chain because they were forced to raise larger funds. And now it feels like they are coming back down to hunt for these opportunities again.
It's not only that they want to focus on the earlier stages, they also want to become more specialized. And I think if you want to be really good in investing in climate tech and bio and health, but also in B2B enterprise, you need to be very early on to also kind of secure a spot in the later rounds, because this is all kind of coming together from like bigger rounds, like not bigger, but like more expensive rounds, but definitely a deal count that is down a lot because definitely also great founders are reconsidering going out into the market at the moment. So that's definitely one reason why, which explains the deal count being so low over the last quarters. But Ameer, if you have anything to add here, feel free to also jump in.
Yeah, I just want to add kind of like how we try to tackle this, because we also invest in emerging managers, and how we make sure that these managers are getting into the best deals with significant ownership percentages. So I would say is that what we want to see with emerging managers is that they have done a lot of thought around how much capital they want to raise, that they know kind of like how large the opportunity set that they're picking out of, making sure that they're only picking the top 1 or 2% of the deals that they're seeing. They have high coverage ratios, they have decent success ratios, and they are securing significant ownership percentages in the companies in their sweet spot, in the sectors or geographies that they're focused on, that once these companies exit, assuming a certain dilution, of course, 10 years from now, this will make sense, and it will be a large enough outcome to generate outsized returns for their funds. That's what I would specifically add on this.
Great, thank you.
Actually, the next point where we wanted to speak about is very much in line with, or at least partly in line with what we've been discussing as well. So it's the deal-making indicator. PitchBook launched this, let's call it KPI, a few years back, leveraging deal-level data to quantify how startup-friendly or investor-friendly the capital raising environment is. And the indicator incorporates not only deal terms and deal attributes, but also fundraising and deal flow data to compose an indicator which compares early and late stage deal dynamics. And as you can see, the graph begins in 2010. Since then, there has been a notable shift in the favorability of deals for startups. Early on, late stage deals were more investor friendly, but starting from 2015, we saw a convergence of terms and deal characteristics, leading to increased startup friendliness at all stages after mid-2020. However, since then, things have changed again drastically from 2022 onwards. The demand for capital, as you know, and as we just discussed, from startups seeking additional funding after large rounds raised in the past 2 years, and therefore caused a sharp reversal in the trend. In fact, this shift is one of the reasons why the current years are expected to become very good vintages in terms of returns, as we move away from extremely startup-friendly environments towards a more investor-friendly landscape. And just quickly linking back to what Ameer said just a minute back, this is definitely one thing where emerging managers can currently stand out in being the investor that picks this up and being at the forefront of selecting the best startups and building up the relationship super early. Moving on to what we've been seeing in fundraising recently. In terms of fundraising activity, we looked particularly into the US. 99 funds raised roughly $12 billion during Q1 of this year, which is roughly the same amount that was raised in the previous quarter. And we estimate a total of around 400 funds to raise 50 to 60 billion by the end of this year, which would roughly be a third of what has been raised in 2022, and therefore marks being back to 2018 to 2019 levels, as we already had predicted during our last macro update. For emerging managers, the trend looks quite similar than the global trend. They reached their fundraising peak in 2021, but since then declined significantly, nearly 40% year over year, resulting in a closing value of only 37 billion in 2022. The downward trend has continued also into 2023, with emerging funds only managing to secure 1.6 billion, accounting to less than 14% of total capital raised in Q1 in the US in VC. this indicates a potential fall below 30 billion for the total value of emerging manager funds in 2023, which would really mark the first decline in 5 years. And moreover, from 2020 to 2022, commitments to established manager peers outpaced commitments to emerging managers by a ratio of 5-1, which you can clearly see on the right part of the slide. One factor which is definitely... Go ahead, Stephan.
Sorry, Alena. No, I think that this is super interesting because obviously we are focused on both, right? So our strong thesis is, yes, there are some fund of funds out there that only focus on very big established firms. We sometimes find them a little bit boring. And then there are some firms out there that purely focus on emerging managers. I think what we are trying to do with this well-balanced approach, that we are obviously covering both sides of the market. I mean, maybe you can give a bit more flavor on this, why we are actually thinking that it's not one or the other, right? The best emerging funds of today will be the big established funds of tomorrow, right? And this is a life cycle also.
Definitely. I mean, we are looking on it from two perspectives. One, from a financial return perspective, where we definitely see baseline performance provided by the more established managers returning, let's say, on average 2 to 3x, and the outlier potential, the so-called alpha of the portfolio, will be provided by more emerging funds that are probably a bit smaller in their fund size, but also more focused towards a certain sector or even geography. That's the financial side of it. But also on a strategic end, and that's definitely something that we got a lot of confirmation for from the market, is that we want to create kind of a portfolio where established managers can benefit from the emerging investments we did, get access to early deal flow, get access to sector-specific knowledge, and really bring them together in building up a network of VCs that supports each other, and also for the more emerging funds to get early advice on how to build a scalable long-term firm that can be around for not only 1 or 2 fund generations, but hopefully for more to come. And looking historically into where have established, like today's established managers started 10, 15, maybe 20 years back, they've all been emerging funds before, right? So we are true advocates of investing in the indexes and hopefully Sequoias of tomorrow. And therefore I think that this kind of balance is definitely super reasonable out of not only the financial, but also a strategic component. And I mean, maybe to add one more thing, we also as the investment team are super excited into like deep diving various sectors and new geographies. We also know that this takes a lot of time and expertise, and also being a fund of fund means combining an opportunistic investment approach with a very thesis-driven one. But there are definitely many interesting fields out there, like deep tech, like climate tech, like bio and health, that we don't want to miss out on. But yeah, maybe on a bit like on a broader scale, also shedding some light on the reasons why emerging managers are experiencing this kind of problem in fundraising, or why they're having more challenges, is definitely that they rely on a relatively smaller network for commitments in terms of fundraising compared to the more established counterparts. And additionally, that's what we're hearing a lot as well from other LPs, emerging funds usually have a very limited track record and lag returns, DPI, due to the relatively young age of their funds. So I always compare like investing into emerging managers with investing into pre-seed and seed companies, because in the end you also really put a ticket into a GP or into a team with a thesis, with a strong vision, and with also the power of execution, and also executing early on it. But yeah, I'm very happy that we can cover this as part of our strategy. looking again once more a bit into the broader market and what these declining commitments to emerging managers could have as a long-term ramification for the venture market, it got obvious that in the past 5 years, approximately 64% of funds raised by firms headquartered outside major markets like the US and so on have come from emerging managers. So these managers represent roughly half of the available capital from smaller market investors. And without these new funds closing, the deal activity in such smaller ecosystems may shift back to areas with larger pools of capital, which would mean kind of a centralization of capital and just less diversification in the field. But enough of fundraising. Over to Ameer again to speak a bit more about the current exit environment and also how interest rates are currently pushing on the venture market.
Thank you, Alena. Okay, for exit and IPO activity, please come again later. Jokes aside, it's evident, like it's clear that after 3 strong years of IPOs from 2019 to 2021, including a record-breaking year for 2021, the IPO window has been closed now for over a year, which slightly led to a slight increase in M&A activity and M&A activity's share of the total exits that have happened in 2022, but also continuing into Q1 of 2023. I think that the recent decline in late-stage valuations offers investment and takeover opportunities for private equity firms, for corporate investors, and for other large tech companies that are sitting on large amounts of cash or have raised substantial amounts of capital, and they're looking to either expand their offering, become more competitive, or maybe even execute on some acqui-hires, especially in the AI and ML space where engineering talent is still at peak record demand. So for example, we have seen some increased M&A activity when it comes to these one specific field of AI and ML in the last few months, with the most notable one being Databricks with a $1.3 billion acquisition of Mosaic ML, which was announced only yesterday. But also Snowflake has been very active in the space, acquiring, I think, 4 companies during the course of the last 6 to 8 months, with the most notable one being Niva, which was closed last month. But there was also been many others in the field as well, most of them on a smaller scale. We expect this to see more and more M&A activity during the second half of 2023. We have been saying this for the last few macro updates now. And again, encouraging all, especially emerging managers, to capitalize on this opportunity, start showing some realizations and DPIs, especially if you're going to be fundraising in the next year or so. This is going to hopefully increase or renew your LP's appetite for VC and give them some cash back to invest back into your funds going forward. And then moreover, what is not mentioned here on the slide. Sorry, go ahead.
Sorry, very quickly on a topic, because I think this is not being discussed often enough, especially with established firms, where we have seen multiple established firms that maybe 10 years ago were started. So they definitely have mature vintages, right? Funds 1, 2, and even funds 3 sometimes. They are at this stage fully mature, but some of them have, you know, strong TVPIs, but extremely low DPIs. Yeah, so I think this is one of the things that I don't know, that a lot of investors in funds are maybe not paying enough attention. Or what is sort of your experience there? Also, maybe from your in total by now, I think also 8 years as an LP in multiple funds.
Yeah, I mean, this is a very good point, Stefan. A big question on how much of this TVPI is going to really turn into DPI, right? We've already been seeing the Q4 benchmarks have been released a few weeks ago, and we've already been seeing some declines. So funds writing down some of their companies. It's going to happen further and further down the road with, again, some of the larger marquee companies having to raise funds. and there will be more down rounds. So it's going to be more and more evident for VCs to write down some of these holdings and cut their TVPIs, lowering the benchmarks. But I think when evaluating funds, both emerging and established managers, maybe not the very emerging funds, but ones that are developing, I would say, if you invested throughout, I don't know, the last 5 or 10 years and went through 2021 with zero cash return to your LPs, and probably you might have missed on some of the best opportunities, or maybe you had the opportunity to liquidate at least a portion of your holding, but you missed on it. So a very good, strong attribute for a fund manager is also being a money manager and not only an investor, right? So it's also a very important skill to know when to sell and not only when to buy. So we have seen some funds more on the established side that have not had strong DPI in the last few years, and I think this is a big miss because they will have to fundraise or are already fundraising, and this is one very big question that will come from their LPs. Show me the money. If you want me to invest in your next fund, you need to return some cash. So some ways of doing that is that we have seen in the last few years being more and more common are GP-led secondaries, where the GP sells a strip of the portfolio in a prior vintage year fund, returning some capital to the LPs, but still enjoying kind of like the upside potential, but definitely helps when fundraising next fund generation. I hope that covers the question, but kind of like touch on the final point that I wanted when it comes to IPO and M&A activity. I think that several of the prominent companies in the last few years, including the likes of Stripe, Databricks, Instacart, Klarna, and many others that have missed the IPO window during 2021, have gone through some significant cost-cutting and efficiency improvement measures, and they are likely considering a potential IPO in the next 10 to 18 months, with I would say kind of like the general consensus in the ecosystem, from VCs to bankers to others that are very close to the assets and to the founders and CEOs of these companies, are suggesting that we will likely see a large IPO sometime in 2024, which will be followed by further smaller IPOs, as has been the case historically. To close things and kind of like one final remark, I think important thing to mention is, as you know, VC is an asset class that is driven by the power law, which means that most of a fund's return will come from a few of its portfolio companies, and the same can be more or less said about portfolio funds. So as you can see on the left-hand side, between 2005 to 2015, only 31% of VC funds were able to generate over 20% net IRR returns, with the top decile returning over 35%. So choosing the right funds becomes even more and more critical in a rising rate environment or a downturn, versus during a bull market where all indicators were going up. So our kind of like what we would say to LPs allocating in VC is put a lot of effort in selecting and getting access to the top quartile funds, or the funds with the highest potential to become top quartile, that have a clear thesis, clear understanding of what they want to build, and they have a very long-term view of what they're building, 100% committed to VC if you want to meet your VC return targets. Or alternatively, you can go with a fund of funds such as AlphaQ, where you can be able to build a very well-diversified portfolio of VC funds. And now handing it over back to Stephan for the Q&A session.
Thanks, Ameer. Yeah, I mean, what we are trying to offer with this also evergreen structure as a fund of fund is vintage diversification out of the box, right? We've talked about right now a lot about the current timing of the market, but it's obviously extremely hard, if not impossible, to time the market. So what is your recommendation for an investor starting out allocating to venture capital when looking at the whole spectrum of possibilities, right? You have obviously fund of funds, you have established funds, emerging funds, direct investments. What is sort of, in your experience, also the recommendation on how to best allocate to venture?
Yeah, I mean, the natural answer to that question is starting with the fund of funds, right? If you haven't allocated to VC in the past, it's a very good way, especially with AQVC, we are giving a lot of work, a lot of effort being put on the reporting side, right? So we want to make sure that you're not only enjoying exposure to VC, but enjoying exposure to the most promising technologies, most promising companies, most promising opportunities in VC. So I think going with the right fund of funds is a very good opportunity for anybody who does not have exposure into VC or has a very small exposure into VC and wants to really expand it, whether it's from a geographic perspective or maybe add a mixture of established funds next to the a few emerging manager tickets that he has done. So a fund of funds can be a very, very good idea. The second high level would be investing directly into funds. Again, you mentioned this earlier, right? There's hundreds, if not thousands, of emerging fund managers out there. Now, naturally, the numbers are coming down, but some of them are going to be unable to raise subsequent funds or even complete their fundraising. So you could be stuck with a small fund that wasn't able to meet its target, so it doesn't have a real strategy and couldn't kind of like generate a significant return. There are many, many different aspects in fund due diligence that really require a lot of expertise, a lot of kind of like attention to detail, spending time with the managers. Again, so doing this on a full-time basis is super important. As Alena had mentioned, this is closer to investing in seed stage rather than later stage, because you need to spend time with the managers, understand the thesis, how the kind of like if it's an emerging manager, how their thesis or strategy is developing, how did they come up with the fund size that they want to raise? Is it just based on management fees that they want to take, kind of like get back, or is it really based on a well thought of model on how to generate 5x plus? What is the option pool, the strength of their networks? Do they have a hustling mentality, and so on and so on and so on, and many other like smaller legal or like operational due diligence aspects that are super important if you really want to build a robust portfolio of funds. And then naturally the last level is angel investing or direct investing, which becomes much higher, requires a much stronger skill set. You need to have access to the right networks. You need to have a very specific value add so that you will be invited to the best deals, and that you have enough capital that you are willing to, if things go wrong, lose also, because eventually it's venture capital. And if you're investing directly, you're going to need to build a large portfolio of companies. I don't know, I would say at least 20 to 50 companies over the course of 2 years if you want to enjoy venture scale returns. So that's how I would kind of like lay out the venture investing landscape.
Maybe just adding one more comment, which for example was not like super clear to me in the beginning, but also investing in a fund of fund when you have the goal of investing like directly into startups is an amazing like opportunity, because you have the chance to follow the underlying companies of the funds that you're invested in very closely. And there are many, especially emerging fund managers, that can't use their pro rata rights up to like the Series A or B. So they usually hand-on follow-on investments to their LP base, which is amazing because you have underlying reports. Ideally, you have looked into the company for 1 or 2 years and then can maybe through that do the first or second angel check.
Yeah, and I think this strategy has been applied not just by us, where we focus on these early stage funds, but Tiger Global, they have over 200 fund of fund investments into early stage funds in order to manage their deal flow, right? And I think this is just a natural progression to make this more available to family offices and corporates and other investors. But one other question, Alena, from the audience that I think is very relevant, and maybe you can help answer that because you look at the emerging managers mostly in our portfolio, is if an emerging manager doesn't have DPI yet, what is the next best representation of value or track record for LPs? What would you be looking at?
Yeah, so I think Ameer already touched a bit on that earlier. So one thing that we really emphasize is the strategy emerging funds carry out, respective to what the market environment currently looks like. It's definitely different if we raise a 30 or a 300 million, maybe second time fund. And then also how you're able to execute on your strategy early on. That's why we are also usually advising to trying to get to a first close pretty early, maybe only with purely high net worth individuals, the first family offices, to start executing on what you're communicating in all of these amazing decks and data rooms that you're sending out. Because only through that, LPs get a feeling of, hey, we can really believe in you. And I mean, for us, it's definitely about the emerging funds being a value add investor to the startups and not necessarily only a value add for us. Of course, that's also nice. But first and foremost, they should be able to select and also access the best funds out there. So that would be kind of the second thing that I would look at first. Ameer, maybe there's anything that you also have in mind to add.
Yeah, I would say it depends on what fund generation you're raising. If you are in your second or third fund generation, I would say in your deck, focus on what have you set out to build in fund one? What did you promise your investors that you wanted to build in fund one? And what have you achieved? If you prove that you have executed on what you set out and what you planned for yourself, this shows very like significant discipline, execution skills, and so on and so on. That's, I think, super important. For first-time fund managers, naturally for institutional investors, you should have some sort of track record, investment track record. Not many institutional investors invest into first-time fund managers with no past investment experience. So be kind of like very institutional ready from day one on how in how you present your data, how you aggregate it, how you show it, show the ownership percentages you were able to get, and then kind of like how you are going to go from strategy 1 to strategy 2, investing your own money as an angel investor, and then investing out of a fund with much more capital. Suddenly you need to think about reserve policy and follow-on capital. So you need to be sure that you have kind of like a very well thought through model that you're going to execute on. Who are your co-investors, but more importantly, also who are your follow-on investors? That's a very strong signal, usually, if you are getting into these deals before the Excels, Indexes, or Sequoias. So many kind of like aspects that you can that show the strength of the portfolio they had built. Also try to highlight a couple of your portfolio companies that had reached significant scale, again, depending on where you are in your journey, but especially nowadays, highlighting companies that have raised at much higher valuations without really like fundamental or like commercial traction is not very well, kind of like doesn't mean a lot, right? But if you can show that these companies are growing at X, they have generated a Y, X, Z in ARR, and these are like real businesses that are growing, operating in a significant market, then that's is much more highly appreciated by LPs rather than just showing up rounds based on hype.
Yeah, absolutely. I think, I mean, in general, you're right. It's back to also fundamentals, right? I think this is very important, but this also right now, and we will see this, I think, in venture all the time, that you always have these hype topics, right? I mean, we see, because of its nature of innovation, of business creation, of visionary founders, visionary investors chasing the next technology shift. What is your, and this is also a question from the audience, what do you, and I mean, I know, but what do you do to kind of distinguish with this, especially emerging managers, but this applies also to established managers, when you evaluate them in deep tech and really hard tech technologies, or even climate tech is the same, that who's riding the wave and this kind of, hype investors versus who's really deeply knowledgeable about that market?
Yeah, that's a good question. I think deep tech is a very broad term, right? It's really hard to kind of like come with a very specific definition of or description of what deep tech is. But I would say for any sector specific fund, it's probably a specific enough sector. Let's take biotech, for example. Okay, that's like a very highly or like a sector that requires high expertise, specific networks, understanding of how a lot of these investments are like spin out from universities, so understanding the dynamics, having the relationships with even the lawyers that know how to negotiate such deals, and with the universities and with the different labs, and having the right kind of like set of experts around you to maybe as LPs in your fund. So that's like one more indicator of if my LPs are these like executive level people or experts in a very specific domain that I'm investing in. This is a very strong signal that I'm utilizing them to try to assess these technologies. But eventually, like it's really hard. If you're investing in managers focused, for example, on biotech, it's probably because it's a little bit hard for you to try to assess the feasibility of the projects that the founders are working on. So one idea could be maybe trying to assess the quality of the founders, right? How many PhDs are on the team? References are very, very highly regarded as well. If you kind of like try to pick a few established fund managers that are investing in deep tech, or in biotech, and ask them, if you are looking for deal flow, would you go to the specific manager and look at his portfolio? Do you take with high regard any deal that he sends your way, or is it mostly deals that you have already passed on? So it's really hard to kind of like differentiate between the hype and the real kind of like experienced, focused investors with real deep expertise. But a lot of the work should be done on.
I think Ameer is stuck, but I can quickly jump in and finish or add to what he was saying, because there was actually one more point. I mean, we as LPs, when we
managers themselves, on the founders, on their backgrounds, because eventually, like, happened.
Yeah, Mia, I think there was just like a
can you hear me now?
A drop in your connection. Yes, but yeah. Alena wanted to finish the point, so maybe Alena, you go on.
Please go ahead.
Just one more thing to add. I mean, when we go deeper with the analysis of funds, we go through their data rooms, we do our homework and so on, and usually it's also a very good indication of, for example, taking climate tech again, like which impact assessments are they using to assess the companies, how deep are the reports or the memos that they're actually writing on the startups that they're looking at, and to which extent are they mainly only following other good investors in the space, chipping some money in and piggybacking some of the DD. That's something I think we can, at least in the meantime, identify pretty early on. But it's also building up the relationship. I mean, it's not like taking one call with a potential GP and then investing in them. It's really hard work building up the relationship, getting intellectual honesty from them. And I'm preaching that since I joined AQVC, but being also honest about what you're not good in and not good at, in terms of maybe it's a subsector of the field you're looking at, then find someone and hire someone that can support you there, or find the best co-investor that you can spare thoughts with. But being honest and transparent about it is definitely, for us as an LP, something that we value a lot.
Yes, and 100%. I think honesty and transparency is super, super important. And also, I mean, keeping the momentum, that you mentioned, what you promise. And you can see this with follow-on rates, re-up rates of existing investors, if it's Fund 2 and Fund 3 also. I mean, one final question here is about exploring new geographies. I mean, we talked a lot about the US market. I mean, initially we talked about France being very exciting in the European scope. What other markets are you personally excited about? Maybe quick, short, final answer. And then we are closing.
Alena, you want to take that?
Yeah, I'm quickly going first. We can both chip in our opinion. So first of all, we're not only looking to the US, we're looking into Europe. The US and Israel as our main geographies, but in general, we have a global mandate. To be honest, I had to learn it the hard way that it's not like we look into the African VC ecosystem and we just make a deep dive and invest into a fund. I think it's important to really build up these relationships, to get to know the ecosystems, and at some point maybe be even on the ground for some time to do the due diligence, because it's really hard to judge something from here. One geography that I'm currently very excited about is the CEE. I think there are very interesting opportunities in terms of moderate valuations, great tech coming out of the universities, so super founder talent, and also more and more emerging managers that are now in fund generation 2 or 3 that have kind of proven strategies and also shown some DPI. That's definitely a deep dive that I want to continue working on over the scope of the year. Ameer, anything else that you're excited about at the moment?
No, I think this pretty much covers sort of like our plan for the next few months. I think we always try to look for, whether it's a new geography or a new sector, what are some of the leading indicators that we are identifying, hopefully very early on, that kind of like mean that this is going to be the next big thing, or this is where the next best entrepreneur, the best company is going to come out of, and then do a deep dive. Try through our fund relationships to get some insights into the geographies, because maybe they have done 1 or 2 investments in that specific geography, and understand kind of like what works best. Does it make sense? Is it a big enough opportunity to have a dedicated fund in the region or not, and so on and so on. But these are all important factors when especially moving into new geographies that are less mature than the obvious ones.
Thank you both. This was a fantastic session. Very, very insightful. And I think we could continue with a lot of this discussion. Maybe next time we leave some more room for that. Final question here for that we will share. Yes, we will share the presentation as well as the recording on our YouTube and LinkedIn channels. But you'll also get an email with that. So thanks also to all our guests who joined us. We had a very nice audience, super good questions, and really looking forward to our next webinar in about 1 month, I think. Yeah, not even that, 3 weeks. So thanks everybody. Speak to you soon.
Thank you so much. Bye bye.